strategic analysis of the global copper market and high-growth small-cap mining equities for 2026. The global copper market in 2026 has transitioned into a new era where the metal is no longer viewed as a cyclical industrial commodity, but as a foundational strategic asset critical to the dual pillars of the 21st century economy, digital infrastructure, and the global energy transition. This red gold narrative is underpinned by a structural deficit emerging from decades of underinvestment in mining capacity, coupled with an unprecedented step change in demand from high-growth sectors such as artificial intelligence or AI, data centers, and the modernization of electrical grids. As copper prices frequently challenge and exceed levels of $13,000 per metric ton, market participants are increasingly focusing on upstream resource plays, particularly small-cap and junior miners that control Tier 1 assets in stable jurisdictions. These companies offer the highest leverage to a multi-year structural repricing, though they also carry significant operational and jurisdictional risks. The 2026 macroeconomic landscape, a market in deficit. The primary driver for the copper market in 2026 is the persistent imbalance between refined supply and a structurally expanding demand profile. J.P. Morgan Global Research anticipates a global refined copper deficit of approximately 330,000 metric tons for the year, a shortfall that has been exacerbated by a series of acute supply disruptions at major mines. One of the most significant impacts came from the world's second-largest copper mine, Grasberg, in Indonesia, where a fatal mudslide triggered a force majeure in late 2025. The Grasberg block cave portion, representing 70% of the mine's previously forecasted production, is not expected to resume operations until the second quarter of 2026, creating a significant hole in global supply. Mine supply growth for 2026 is currently estimated at only plus 1.4%, which is approximately 500,000 metric tons lower than initial projections. This limited growth occurs against a backdrop of declining ore grades across established copper districts and lengthening lead times for new mine developments. Consequently, the ability of large-scale producers to ramp up production in response to high prices is severely constrained. Demand transformation, AI, grid modernization, and national security. The narrative surrounding copper demand has shifted from traditional manufacturing and construction to high-tech and strategic applications. The explosive growth of AI infrastructure and the associated need for compute power has turned data centers into a major new consumer of the red metal. In 2026, data center installations are projected to consume 475,000 metric tons of copper, an increase of 110,000 metric tons over the previous year. Digital infrastructure typically requires high copper intensity, estimated at 12 to 15 tons of copper per megawatt of capacity, primarily for power distribution, cooling systems, and specialized wiring. Simultaneously, the global push toward net zero targets and renewable energy integration is driving massive investments in smart grids and electrical infrastructure. Grid-related demand is projected to account for more than 60% of copper demand growth through 2030, essentially adding the equivalent of the total consumption of the United States to the global market within this decade. Transport electrification also remains a robust driver, with global electric vehicle, or EV, sales reaching 13.6 million units in 2024 and maintaining growth rates of 25 to 35% annually through 2026. Each EV contains significantly more copper than a conventional combustion engine vehicle, contributing to a cumulative demand increase of 350,000 to 450,000 tons from this sector alone. Beyond industrial and technological use, copper is increasingly framed within a national security context. Initiatives focused on supply chain resilience and infrastructure modernization have led governments to prioritize domestic production. This strategic framing supports elevated pricing and creates a bifurcation in equity performance, favoring miners in low-risk jurisdictions that can provide secure, long-term supply. Here is a summary of 2026 market metric estimates from institutional sources. J.P. Morgan has estimated global refined deficit of 330,000 metric tons for 2026, mine supply growth of plus 1.4%, data center copper demand of 475,000 metric tons, average copper price of $12,075 per ton, and quarter two peak copper price of $12,500 per ton. Goldman Sachs forecast for fair value, copper price is $11,500 per ton, and year-end price forecast is $11,000 per ton. Pricing dynamics and technical analysis for 2026. Institutional forecasts for copper prices in 2026 vary, reflecting different assumptions regarding the global supply balance and the timing of U.S. trade policies. J.P. Morgan remains bullish, projecting that prices will average $12,075 per metric ton for the full year, peaking at $12,500 per metric ton in the second quarter. Citigroup, or Citi, has suggested that if supply shortages and low inventories persist, copper could potentially exceed $13,000 per ton and even approach $15,000 per ton during 2026. However, Goldman Sachs research offers a more moderated outlook, expecting prices to decline somewhat from recent record highs of $11,771 per metric ton. Goldman's base case predicts a market surplus of 160,000 to 300,000 metric tons in 2026, which they believe will prevent prices from exceeding $11,000 for a sustained period. A significant catalyst for a potential price correction is the implementation of U.S. refined copper tariffs. The Trump administration is expected to announce a 15% to 25% tariff by mid-2026, which may signal the end of a stockpiling cycle in the U.S. and allow global prices to move lower toward a fundamental fair price of $11,500 per metric ton. Technical momentum and market sentiment. Technical indicators in early 2026 suggest that copper remains in a robust long-term uptrend. Prices on the London Metal Exchange reached record highs of $13,238 per ton in January 2026, with the metal trading consistently above the $5.80 per pound level on the COMEX. Monthly charts show prices hugging the upper Bollinger Band, indicating strong momentum and a phase of trend expansion. The average directional index, or ADX, is near 40, confirming a strong trend, while the rising average true range, or ATR, reflects the volatility typical of a major acceleration phase. Key technical levels for the remainder of 2026 include near-term support at $5.10 per pound and deep support at $4.40 per pound. On the upside, targets include $6.20 per pound and potentially as high as $7.00 per pound if the scarcity narrative continues to drive institutional rotation from gold and silver into base metals. Investment infrastructure. Accessing copper exposure, investors can gain exposure to the copper theme through physical assets, digital derivatives, or mining equities, each with unique tax and liquidity profiles. ETFs and mining equities, exchange-traded funds, or ETFs, remain the most popular vehicle for both retail and institutional investors. Broad mining ETFs, such as the Global X Copper Miners ETF, ticker COPX, and the iShares Copper and Metals Mining ETF, ticker ICOP, provide diversified exposure to established majors like Freeport-McMoRan, BHP Group, and Rio Tinto. These funds allow investors to benefit from operational leverage and dividends, which many major miners pay, thereby adding a layer of return beyond simple price appreciation. However, large-cap miners are rarely pure plays, as they often produce significant quantities of gold, iron ore, or molybdenum, which can dilute copper exposure. For direct tracking of the copper price, the United States Copper Index Fund, ticker CPER, utilizes a portfolio of copper futures contracts. While CPER offers high liquidity, it is subject to roll yield, the cost of rolling expiring contracts into new ones. In a contango market, where future prices are higher than current prices, this roll cost can erode investor returns over time. Furthermore, CPER is structured as a partnership, requiring investors to handle K-1 tax forms, which may be a deterrent for some retail participants.